Imagine looking at your portfolio, right? And you see this stock that is up like 210% over the last year.
Oh, you're feeling like an absolute genius at that point.
Exactly. It's climbing. It's got this incredible momentum. And it actually hits its 52-week high just days ago. You think you caught a rocket.
Right.
And then literally without warning, the floor just falls out. It plummets almost 19% in a single day. Yeah. So are you looking at a fundamentally broken trend, a massive flashing sell signal? Or is this somehow the ultimate undervalued strong buy opportunity just masquerading as a total disaster?
I mean, that is the absolute definition of a market paradox.
Yeah.
Because when you see violent daily price action that directly contradicts a massive long-term uptrend, something fundamental is breaking or, well, being completely rebuilt under the surface.
And that rebuild is exactly what our sole focus is for today's deep dive. We are putting Sidus Space Inc., ticker symbol SIDU, under the microscope.
It's a fascinating one.
It really is. We're tearing into their latest 2025 earnings, dissecting this massive new equity offering, and, really trying to make sense of the completely conflicting signals that are just tearing financial analysts apart right now.
Yeah, the divide there is wild.
We've got the raw data, we've got the order flow mechanics, and we're going to help you figure out what is actually happening under the hood here.
Definitely.
Now, before we rip into the income statements and the short seller psychology, just remember, we're strictly analyzing the data today. This is for educational and informational purposes only, absolutely not financial advice.
Right. Do your own research.
Always. And if you enjoy this kind of raw analysis, throwing a like on the video, subscribing to the channel, and telling us your thesis in the comments, that is the absolute best way to keep these deep dives coming. We really want to know how you read these charts.
Yeah, the comment section on these volatile plays is always fascinating to me because retail traders and institutional algorithms tend to view the exact same data points through completely different lenses.
It's so true. So let's start by defining the whiplash here, because to even talk about the long-term potential of Sidus Space, you have to establish the brutal reality of the short-term tape.
You do. You have to look at where we are right now.
Right. So as of the close on April 20, 2026, the stock is sitting at $4.34. That is down $1.01. So an 18.88% drop in a single trading session.
Oof. A drop of that magnitude, I mean, that shakes the conviction of even the most hardened long-term holders.
Especially because just 4 days prior to this drop on April 16th, it hit its 52-week high of $5.99.
Which is an incredible run if you zoom out.
It is. If you rewind to December 1st of 2025, this stock was trading at 63 cents.
Wow.
We're talking about a climb from 63 cents to basically $6, and then bam, a sudden violent trapdoor opens.
Right. And we know exactly what opened that trapdoor.
We do. The catalyst for this immediate short-term bloodbath was the company announcing a massive $58.5 million equity offering, and they priced those new shares at $4.35 each.
See, the timing and the pricing of that offering reveal basically everything about management's priorities right now.
How so?
Well, when a company with a market cap of roughly 288.7 million issues 58.5 million in new equity, they aren't just raising a little operational cash.
Right, that's a huge chunk of the company.
Exactly. They are fundamentally altering the supply and demand mechanics of their own stock. You are injecting this massive new supply of shares straight into the open market.
It's like they just issued thousands of new VIP tickets to a sold-out concert, but they didn't bother to expand the stadium.
That's a great way to put it.
Right, the music hasn't even started yet, and suddenly everyone's view is blocked, and the original ticket holders feel totally cheated. But my main question is about the timing.
Okay.
If your stock is rallying towards $6 on incredible momentum, why drop an anvil on it? Why price the new shares at a steep discount of $4.35 and kill your own rally?
Because momentum is fragile, right?
Yeah.
But cash is tangible.
Okay, fair point.
Management watched the stock run up from under $1 to nearly $6. They know their own internal cash burn rate better than anyone. By offering shares at 4.35, they're basically offering institutional buyers a discount to the current trading price in exchange for guaranteed immediate liquidity.
So it's a trade-off.
Exactly. The company secures nearly $60 million in hard cash to fund operations, and the institutions get a block of shares well below the recent highs.
Leaving the retail traders, the ones who bought the breakout at like $5.50, just completely holding the bag as the stock price immediately craters to match the offering price.
Yeah, that is the harsh reality of the dilution factor. The market enforces efficiency.
Yeah, it does.
If a massive block of new shares is suddenly available at 4.35, the open market price is going to violently re-rate to that level. But it's really vital to separate the short-term pain from the long-term mechanics here.
Okay, let's separate them.
Even after that 19% single-day drop, the trailing one-year return is still a deeply bullish positive 210%.
That is wild to think about.
Right. And remember, the company didn't lose a major contract. They didn't report some catastrophic satellite failure. They sold equity to fill their treasury. To understand if that was a smart move or a really desperate one, you have to look at what they're actually financing.
Which brings us directly to the fiscal year 2025 financial statements. Because, a company doesn't dilute its shareholders by 20% overnight unless there's a very specific and usually very expensive reason.
No, they certainly don't.
So we pull the annual reports, and the numbers are jarring.
They're tough to look at. Yeah.
Revenue actually fell 28% year over year. It dropped down to $3.38 million. And net losses, they widened drastically.
From what to what?
From a $17.5 million loss in 2024 to a $29.47 million loss in 2025.
Oh.
Yeah. But the metric that absolutely stops you in your tracks is the gross margin. It is a staggering negative 168%.
Yeah, negative 168% on the gross line that's the kind of metric that usually signals an existential crisis for a business. Seriously. If I run a lemonade stand and it costs me nearly $3 in raw materials to make a cup that I sell for a single dollar, I don't call that a transitionary period. I call that a structurally failed business. How do you possibly defend a negative 168% gross margin?
Well, in a traditional retail or software business, you couldn't. You'd be bankrupt.
Right.
But in the aerospace sector, that number actually tells a story of aggressive capital expenditure that is just disguised as an immediate operational loss.
Okay, walk me through that.
You have to understand the mechanics of the pivot Sidus is attempting right now. They're aggressively shifting into a space-as-a-service model.
Space-as-a-service. Got it.
Right. Historically, they generated revenue through one-off hardware sales, specific manufacturing contracts, or, consulting. That revenue is recognizable immediately, but it's highly unpredictable and generally lower margin.
Right. You build a part, you sell the part, you record the revenue. It's simple.
Simple, but really hard to scale. The pivot involves building their own proprietary satellite constellation, the LizzieSat network.
They want to put those assets into low Earth orbit and then sell the data, the sensor bandwidth, and the payload hosting on a recurring subscription basis. They want to be a data utility company, not just a metal fabricator.
That makes sense conceptually.
But getting a data constellation into orbit requires an enormous upfront cash burn. That negative 168% gross margin is heavily driven by the sheer cost of building and deploying these satellites, combined with the massive accelerated depreciation expenses of space hardware.
I hear that, but I want to push back on that a bit, though.
Sure.
Because a 68% jump in net losses is massive. You can't just wave a magic wand over a terrible income statement, whisper the word CapEx, and expect investors to just be okay with it.
That's a fair point.
They're intentionally letting their old hardware revenue dry up, which explains the 28% drop in top-line sales, while pouring tens of millions into this space-as-a-service model that isn't even fully monetized yet. They're essentially caught in the dead zone between two completely different business models.
And that dead zone is precisely why they needed the $58.5 million equity offering. They are racing against their own burn rate right now.
Literally a race against time.
Exactly. But if you look at the balance sheet, you do start to see the method behind the madness. Their cash position is up 175% year over year, sitting at $43.2 million.
Okay, that's a healthy cushion.
It is, and far more importantly, they are reporting zero outstanding term debt as of early 2026.
Wait, zero debt? For a space startup burning nearly $30 million a year, that is incredibly rare.
Very rare.
Usually these companies are leveraged to the absolute hilt, and one delayed launch puts them in default with their creditors.
Right, and that is the exact mechanism protecting them from bankruptcy right now.
By
financing this transition entirely through equity raises. They generated $36.91 million in financing cash flow purely from capital raises. In the latest quarter, management is consciously choosing shareholder dilution over corporate debt.
Which is a huge distinction.
It is. Debt requires fixed interest payments, which drain your cash regardless of your launch schedule. Equity dilution hurts the share price, yeah, but it provides unencumbered runway. They have fortified their balance sheet to ensure they can survive the R&D phase of the LizzieSat network without a bank suddenly calling in a loan.
Okay, so it's a calculated trade-off. They're punishing current shareholders to guarantee the company survives long enough to actually launch the product.
Precisely.
But let's move past the balance sheet and look at how the actual market participants are reacting to this trade-off. Because we pulled the technical charts and the order flow data, and the tug-of-war happening right now is just fascinating.
The mechanics of the current order flow are actually creating a massive trap for inexperienced traders.
Let's break down exactly why. Because if you look at the traditional technical signals, they are screaming strength.
Oh, absolutely.
The moving averages are flashing a strong buy. Even after plummeting to 4.34, the current price is sitting comfortably above the 60-day moving average of 2.61, and it is miles above the 200-day moving average of 1.75. The long-term trend is undeniable. The MACD indicator is crossing bullish.
Right.
But the momentum indicators, like the RSI, are teetering on overbought territory, which tells us that the buying frenzy leading up to April 16 basically exhausted the bulls. There was simply no one left to keep pushing the price higher.
And that exhaustion hit an absolute brick wall the moment the 4.35 offering was announced. That offering price didn't just dilute the shares, it created a very real psychological ceiling on the stock.
How so? Walk us through the psychology of, say, an institutional buyer taking part in that offering versus your average retail trader.
Okay, so imagine you are an institutional fund manager. Sidus offers you a massive block of shares directly at 4.35.
Okay.
You buy in. A week later, the open market price drifts up to, let's say, 4.8.
This little gain.
Right. As a fund manager, you can instantly dump those shares on the open market for a nearly 10% risk-free return in a matter of days.
Wow.
So that creates an immense wall of selling pressure, what we call resistance, sitting right above the current price. Every time the stock tries to rally toward $5, the institutions who bought the discount just unload their shares for a quick profit, completely squashing the rally.
So the big money acts as this giant wet blanket on the chart.
Exactly.
Meanwhile, you have retail traders who bought the breakout at 550 or 590. They are trapped deeply underwater. They're watching this volatility, experiencing the psychological pain of the daily swings, and many will eventually panic sell just to stop the bleeding, which just pushes the price down even further.
Which brings us to arguably the most complex dynamic on the board here, the battle between insiders and short sellers.
Oh, this is the best part.
It's wild. These represent two factions of quote-unquote smart money, taking entirely opposing views on how this whole thing plays out.
Let's look at the insiders first. So company directors, specifically names like Dana Kilborn and Jeffrey Schuman, are holding their direct interests. We aren't seeing the kind of panicked mass exodus of executive shares that usually precedes a total collapse.
No, not at all.
In fact, if you look at the last 100 aggregated insider trades on file, the data shows 100% buy activity. The people steering the ship are acquiring shares, not dumping them.
And insiders only buy for one reason, right? They believe the equity will appreciate. They have visibility into the LizzieSat data contracts that the public just doesn't have yet.
But then on the flip side, the short sellers are looking at the exact same company and placing a massive bet against it. Short interest is creeping up steadily.
Yeah.
Currently, 11.19% of the floating shares, which is about 7.4 million shares, are sold short. And that short interest increased by 8.5% just recently. To be clear, 11% short interest on a small-cap space stock is a heavy, aggressive bet that the price is going to crack.
Well, short thesis is entirely mechanical. Short sellers are basically betting against the clock. They see the widening net loss of nearly $30 million. They see that $43 million cash pile. They do the basic math and conclude that Sidus is going to burn through that cash before the high-margin recurring revenue ever fully materializes.
And what happens when a company with zero debt runs out of cash? They issue another equity offering.
Exactly. They dilute again. The short sellers are borrowing shares today, assuming that another massive dilution event will inevitably drive the stock down to the $2 or $3 range, allowing them to cover their positions for a massive profit.
Wow.
They are betting the transition to space as a service is just too slow, too expensive, and ultimately fatal to the current share structure.
So this tug-of-war, you have insiders betting the pivot works, shorts betting the cash runs out, perfectly mirrors the absolute chaos we are seeing among the financial analysts valuing this company.
Oh, the analyst reports are all over the place.
We are looking at a valuation chasm that is honestly absurd. I'm not sure I've ever seen a gap between a bull case and a bear case this wide.
It really ceases to be a difference of opinion and becomes a fundamental disagreement on the reality of the business model.
Right. Let's break down the two extremes here. On the bullish side, you have a consensus among the analysts tracking this stock, rating it a strong buy. Their 12-month average price target is $10.20.
Right.
Based on today's price, that implies an upside of well over 100%. They are forecasting massive growth.
Yeah.
But then you run the company's current financials through an algorithmic valuation tool like AlphaSpread, and it claims the stock is 97% overvalued.
97%.
Yeah. The algorithm calculates an intrinsic value of just 18 cents.
18 cents versus $10.20.
That's crazy.
To understand why those numbers exist, we really have to pull apart the mathematical assumptions driving both models.
Please do.
Let's look at the algorithm's 18-cent valuation first. An automated tool like AlphaSpread relies heavily on discounted cash flow models. It looks at the present reality, shrinking top-line revenue and a massive accelerating cash burn. The algorithm projects that negative cash flow into the future, penalizes the company for the lack of imminent profitability, and spits out a near-zero valuation because it basically assumes the company will literally burn itself into the ground.
Right. The algorithm doesn't care about the narrative. It doesn't care about a, quote, pivot. It just looks at the cash going out the door and says, this trajectory leads to a penny stock.
Exactly.
It also flags the price-to-book ratio, which sits at 5.6x. That's higher than the broader market average of 4.4x. Though to be fair, direct peers in the highly speculative space sector often trade at much higher multiples, closer to like 9.7x.
Which means the broader market is actually applying a transition penalty to Sidus. They are trading at a discount to their peers simply because they haven't proven the new model works yet.
Okay, so that's the harsh mechanical bear case that spits out 18 cents. But what are the human analysts seeing that gets them to a $10.20 price target? What is the core assumption propping up that massive valuation?
It hinges entirely on a concept called flight heritage and the revenue multiples associated with data.
Flight heritage.
Yeah. In March 2025, Sidus successfully launched LizzieSat 3. Space is an incredibly unforgiving environment, right? Getting hardware into orbit and proving it functions correctly is a massive de-risking event. That successful launch proves their engineering is sound. The analysts are taking that flight heritage and projecting it forward.
So they aren't valuing the company based on the hardware they sold yesterday. They are valuing the company based on the data they will sell tomorrow.
Precisely. The analysts assume that with the $58 million in fresh liquidity, Sidus has the runway to fully deploy the constellation.
Right.
Once deployed, the revenue model completely shifts. Selling satellite data or hosting third-party payloads operates much more like a software business. The margins flip from deeply negative to highly positive.
And Wall Street loves that.
Wall Street assigns massive valuation multiples to recurring, high-margin revenue. The 10.20 target assumes this transition is executed flawlessly, the cash burn stabilizes, and the data contracts actually start hitting the income statement.
But the reality is that profitability isn't even expected in 2026. The bears are right about the timeline. It's going to be a long, expensive road.
It is.
If the space-as-a-service revenue is delayed by launch scrubs, regulatory hurdles, or simply a lack of customer demand, the bull's $10 target just evaporates, and the algorithm's 18-cent warning becomes a self-fulfilling prophecy.
And that is the razor's edge the stock is walking right now.
Truly.
The best-case scenario validates the strong buy. The recurring revenue turns on, the margins explode positively, and the market aggressively reprices the stock for a successful sauce pivot.
And the worst-case scenario?
The worst-case scenario validates the short sellers. Cash burn vastly outpaces revenue generation, forcing management back to the market for another brutal equity offering, diluting shareholders again, and sending the stock spiraling toward those long-term technical support levels.
Which gives us a very clear roadmap for what you should be watching in the coming weeks and months. We've covered a massive amount of ground today, from a 210% long-term run up to a 19% single-day crash, the mechanics of a negative 168% gross margin, a balance sheet fortified by zero debt, and a valuation debate spanning from literal pennies to double digits.
That's a lot to process.
It is. So how should a listener synthesize all of this data? What is the immediate outlook here?
In the immediate short term, expect heavy consolidation. The market has to digest the massive new supply of shares from that $58.5 million offering.
Right.
We are highly likely to see the stock just chop around in the 4.0 to 4.50 range. It is trapped. The institutional sellers who bought the offering will cap the upside resistance, and the fundamental value of the cash reserves will likely defend the immediate downside support at 3.95.
So it's basically going to trade sideways while the market holds its breath. And what about the medium to long-term horizon? What breaks the stock out of that trap?
It comes down to one indisputable metric: top-line revenue growth generated from the LizzieSat constellation.
Prove it, basically.
Exactly. Management has raised the cash, they have diluted the shareholders, the market has paid the price for the transition. Now management must provide the proof. If subsequent earnings reports fail to show measurable, recurring revenue growth from the space-as-a-service model, investor patience will just evaporate.
And if that momentum breaks?
If that momentum breaks, we could easily see the stock crack that 3.95 support and initiate a long, painful slide to retest the critical 200-day moving average all the way down at 1.75.
Wow. It is an incredible high-stakes corporate drama. You have a company battling an astronomical cash burn, enforcing massive share dilution, and attempting a highly speculative business pivot in the most difficult operating environment imaginable, low Earth orbit.
Yeah, you can't get much harder than space.
Right, but they are doing it with a $43 million war chest and absolutely zero debt tying their hands. It's the ultimate high-wire act. Now, again, we want to emphasize that today was an exploration of the mechanical data, the order flow psychology, and the fundamentals of this business. It's strictly not financial advice.
Absolutely. It's just a deep dive into how raw numbers translate into market reality.
And as you look at that reality, it leaves us with one final lingering thought. Think back to the sheer complexity of what Sidus Space is attempting here. If a company decides to fundamentally shift its entire business model while its products are literally floating in the vacuum of space, are you betting your money on the hardware they managed to launch, or are you really betting on the executives steering the transition? Let us know what you think in the comments below. We'll see you next time.